This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, January 23rd, 2023 edition. And 1 month ago, we were getting ready for the new year. And today we are starting the fourth trading week of the year. And so far, it's been a pretty fruitful one. Definitely more bullish than most people had been expecting the month of December. A lot of tax loss selling. It was a bit of a rough December. And a lot of people thought the market was going to break down. And really, the opposite has happened. We've broken to the upside on the back of a potential Fed pivot. Now, that's the short-term gyrations of the market. And too often, people get caught up in that, chasing the returns, and oftentimes those emotions that these price movements can bring means bad decision making. And so that's why on this show, our goal is to help keep you on the right path, give you the right perspective, give you the right data, and keep paying attention to the things that matter, not the shiny headline, not the shiny object of the hot stock or sector of the day. It's more about having the right mindset to make good investment decisions consistently. So as we know, market dynamics are shifting and you need to be reacting in real time. And having, like I said, the proper perspective in order to build a more balanced portfolio for your goals and your risk tolerance level. So I'm Justin Klein. I'm here on today's radio show and program to answer your finance and investment questions, to help you develop portfolio strategies and make solid, good decisions with your money on a consistent basis. With facts in hands, not with emotion, with the facts on the ground. And so that you're investing based on the reality of the situation as opposed to the hopes and dreams of yourself or somebody you've talked to. It's about how to make the most of the market that we're in, that you're presented with. So our phone lines are open 24 hours a day, 7 days a week at 888-99 chart. And I've got a lot of material for you today. One is on the pros and cons of investing in REITs versus direct real estate. A lot of people want to get into real estate investing, and about 70% of rental homes, individual homes, are owned by individual investors. And there are pros and cons of each, just like everything. There's pros and cons to REITs versus owning one or multiple pieces of property directly, and we're going to get into all of that. Which one makes sense for you? I think we're going to do a good job of answering that question. I also have some other topics to discuss, time permitting. One is in regards to offshore oil market. That has been dormant for a while, but it's making a bit of a comeback. So we're going to look at that. Also, home remodeling. We know that the housing market's slowing, but what does the home remodeling market look like as well? And how does that feed into those type of names? And then the buy the dip mentality in the tech sector is almost all but dead, except for one company. And I'm going to reveal what that company is a little bit later. Now, my perspective for this Monday looks at real world numbers with regards to inflation, what things cost 100 years back and what they cost today. So I've got this all planned for this episode of InvestTalk. And of course, most importantly, your live calls at 888-99 chart. Let's take a look at the market today. It was a decidedly positive day overall. You had the broad U.S. market up about 1.25%. The small caps did the best, up about 1.5%. Mid caps up about 1.4%. And you had really the growth side of the market is starting to perk up. This is what I said on my YouTube video on Friday, is that with the Fed pivot in the offing, right? The Fed pause, I call it. That's going to likely bring a relief rally in the growth side of the market, in the tech sector. And you're getting a bit of an outperformance near term. You had semiconductors up nicely today, up about 4%. So that was a good move there. And that's been outperforming here for most of the start of the year. So would not shock me to see this be a quarter where growth actually outperforms value for the first time in a while. Why is that? Well, inflation's coming down. Interest rates have pulled back. The 10-year is now at 4.52, up 4 basis points today. But that's down from 4.25, 4.3 or so back in October. So that's certainly helping the growthier side of the market. So you're always going to get that, right? Where I always say we are in an era where value is likely to outperform, but there will be quarters where growth outperforms. Just like from 2007 to 2021, that was a period where growth outperformed, but there were years and a lot of quarters where value had its day in the sun. And you're going to get the same thing. Right? You're going to get counter trend rallies, and I think we're in the midst of one. Maybe a time to think about how to rebalance out of those names if you're overweight the growth side of the market. And you're going to be entering likely a period where you get a bit better prices there. And if you're a trader, that's the area that may get some outperformance in the near term. So that's my just quick synopsis of what happened today. And this is so far a positive time in the market. I think really pricing in that Fed pause, which likely will come either after this next Fed meeting in February or in March. And that was kind of leaked over the weekend that they're going to discuss that at the meeting coming up next week. This is next, what's the first, Wednesday? Yeah, next Wednesday will be the Fed meeting, Fed announcement. And they talked about that's when they will discuss whether or not what is needed for that Fed pause. And the economic data that is coming in, is really backing up that there should be a Fed pause near term. Now we're heading into a break. Steve and I are happy to play your recorded voice bank questions, but we very much enjoy taking your live calls as well. And that means our number never changes and it never closes. It's InvestTalk at 888-99-CHART.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. With total downloads nearing 50 million, each InvestTalk podcast should be one of your key financial planning and educational tools. InvestTalk is a free download, and hosts Justin Klein and Steve Peaslee stand ready to provide their unbiased guidance and professional analysis developed from real-time data research and years of investing experience. 24/7, rain or shine, during smooth sailing or on rough weather days. The InvestTalk listener line is open and waiting for your questions. You set the agenda. Don't forget to call InvestTalk 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy and discipline. And along the way, you're sure to have finance and investment questions. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Hey, Justin and Steve, this is Andrew from Atlanta. Giving you a phone call. I bought CPRX, Catalyst Pharmaceuticals. It has dropped like over 33% today. Something about Teva Pharmaceuticals is going to start selling a generic version of one of their medications. listen, going forward, is this anything to be highly concerned about, or is this just day to day, up and down? I'm curious if I could please get your take on the current status of this stock. I appreciate your help. Thank you.
All right, CPRX, which is Catalyst Pharmaceuticals, down 29% today on that news. I'm not too familiar with this, but I will say this. This has rallied pretty dramatically from about $5 early last year all the way to a high of around 22 just last week. Now falling 29% down to $14.76 on huge volume. When you get large sell-offs like this on big volume after a big run, it likely means it wants to go lower. It doesn't mean you can't get a near-term bounce, but that would worry me. These smaller cap names are typically reliant on one or two drugs, and if there is one that suddenly comes under threat from the generics, then that can mean big problems for their business. So I'd really have to dig into it to make sure, but I don't like the sound of it, and I don't like the chart. So I would take your losses, take your lumps. Maybe you have gains. Hopefully you bought it a while ago. But I would move out of it and onto something else because I don't like that overhang, and it's only about $1.5 billion market cap stock, and these things can be pretty wild. Okay, and so I would move on. Thanks for the call. Now, my focus point concerns this story: the pros and cons of investing in REITs versus direct real estate. And real estate is one of those things that is very popular, right? It's a large part of many investors' portfolio. And you should probably have some real estate in your portfolio. 5, 10, 20% of your liquid assets, probably not more than 20, of your total assets, because obviously direct real estate isn't liquid. But your total assets probably shouldn't exceed 20, but having 5 to 20% in real estate isn't necessarily a bad thing. But there's spectrums. There's a spectrum of how much you are involved in the actual investing part of real estate, right? There's more active investments, which is one could be ground up construction, right? Becoming a developer, that's very hands-on. Then there's the fix and flip crowd, which goes and buys up dilapidated buildings and homes and trying to fix them up and bring value to them, value add projects. And then there's just your standard owning, managing longer term rentals, or sometimes Airbnb now, which is that's pretty hands-on as well. And then you go into the passive realm, hiring a property manager. Maybe you have being a silent partner in a broader investment, and then it goes into individual REITs or REIT mutual funds, and that's very hands off. Okay, so that's kind of the spectrum when it comes to real estate. Now, what are the pros and cons of investing in REITs? Now, 45% of American households own a REIT of some kind. That's double from 2 decades ago. And the good thing about REITs is you get diversification without a lot of commitment of what owning a single property and dealing with single tenants comes with, right? So when you buy a REIT, it's a lot easier to buy and sell, more liquid. This is a private REIT, which you definitely want to stay away from, but talking public REITs mainly. These public REITs, they're liquid. You want to sell a physical property, you have to go list it and find a buyer for it. Takes oftentimes many months, especially in this market. And then there's the diversification aspect. You get to diversify into hundreds, if not thousands of properties in many of these REITs. So you avoid the concentrated portfolio. And then you can gain access to out-of-area type of investments, sometimes even out of country. And a lot of times the returns there are even better than domestically. I think of here in California. I live in California. Investing in your rental real estate market right now, your cap rate's maybe 3%, maybe up to 4% now, but still that's meager compared to what you're getting in the corporate bond market, for example. So if you want good rates, good cap rates, you're going to need to go out of state. And some people, just don't want to do that. Okay. And deal with properties that are hundreds, if not thousands of miles away. Okay. And REITs enjoy a favorable tax treatment, meaning that they're pass-through entities. So REITs don't pay tax on the corporate level, right? It's not a corporation, it's a pass-through entity. But that also means that when you get the dividends, you're paid out you're taxed at a higher rate, right? Those dividends are taxed at your ordinary income tax rate, and sometimes that can be a good thing or a bad thing. Okay, so that's REITs. But after the break, I'm going to get into physical real estate. What are the pros and cons there? Now, the market is constantly changing, and that means you probably have questions. So I'm ready to take them right now on InvestTalk at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now, before the break, I talked a bit about the nice diversity and liquidity that comes with investing in REITs, public REITs, not private REITs. Remember, you want to stay away from those. But what about directly owning real estate? Now, the first major benefit of that is going to be from a tax perspective. So if you're in a high tax bracket, what a lot of real estate investors do, you buy a property and you can quickly depreciate it. And even though you're cash flow positive from a tax perspective, you're depreciating the asset fast and you're avoiding a lot of tax. And there's a lot of people that do that. And you never capture that tax back until you sell the property. And many of them don't ever sell a property, right? They pass that on to their next of kin. So there are substantial tax benefits, which you want to talk to an accountant about in your own situation. And it depends on the property, et cetera. But the first question you always have to ask yourself when you're owning real estate directly is, how active do you want to be? And what type of risk tolerance do you have? There's a wide range of potential outcomes when it comes to investing in a single property. You can make really great decisions or really terrible decisions based on what you pay, where you buy it, what's the local market like, etc. So it's certainly higher risk to own individual properties. It also requires a lot of cash, due diligence, time. Even if you rely on a property manager, you still need to be involved in some way. And a property manager cuts into your cash flow and your margins. And if you need cash, once again, liquidity isn't really there. You can't sell part of a property. You sell all of it or none. Usually. So if you have extra time and some extra cash, that might be right for you. So if you're, in summary, if you're a successful, busy professional, direct property ownership, pretty costly and time intensive. Dealing with tenants and maintenance probably isn't your thing. And if you live in an area that doesn't have high cap rates, meaning high returns on those rentals, that's also a big drawback. So passively investing in REITs is probably the better choice. Now, if your job is more flexible, maybe you're a work from home or part-time work, maybe real estate can be your hobby, your part-time job, your other part-time job. So as long as you have the risk appetite, the liquidity, and the willingness to put in work. If you don't have all those, well, then REITs are probably still your answer. But once again, active investors, you can hit home runs. If you're willing to put in the work, do the research, find the right people, find remodels, fixer-uppers, that can be an option, etc. But there's always downside, right? Purchasing an illiquid asset can be costly if you make the wrong decision. Now, if you're retired, you have a lot of time in your hands. Maybe you're downsizing instead of selling your home, which you used to, live in. Maybe you just rent it. Still in your local area, you go and fix the problems, and you deal with the tenant. You have one, maybe a handful of rentals, and that might be right for you. So it's really important to get this right, because a lot of people are all about real estate investing. And I think there's certain, like I said at the top, a percentage of everyone's assets should be in real estate to a degree. But you really have to go with your eyes wide open and know which option is right for you. Now let's go to Richard in Santa Clarita looking at Volkswagen.
Yes. Hi, Justin. I wanted to ask about Volkswagen, VWAGY. Something happened today which kind of unique, I guess. They paid a special dividend, a dividend that instead of the a little over 78 cents, it's $2.04. So it's a good dividend. But how does that affect this stock? And I think it might have something to do with their relationship with Porsche. Is that giving out a special dividend a good sign? Is Volkswagen right now at a price where it's a good investment?
Well, I always say this. A lot of people are hung up on the car industry. It's very top of mind. You see a lot of cars on the road, right? Your friend, your cousin, your brother might have bought a car, and it might be nice and you like it or whatever. But typically, if you understand businesses, the auto industry is really one of the worst businesses to be in. It's very competitive. It's highly capital intensive. You deal with unions if you're producing here in the U.S. And, it's up and down. Depends on what's hot, what models are hot and how good of a job you're doing with production and design, et cetera. But I will say Porsche is probably, or Volkswagen is one of the best in the world when it comes full stack, from production efficiency, design, et cetera. But it's still a relatively poor investment long term. So I'm not sure about the details of the special dividend, but not a name that I get excited about. I think it's just it's not bad. It's just a lot of better opportunities. Focus on ones, the OEM parts manufacturers that supply Volkswagen. Those tend to be better investments. Thanks for the call. Now we're heading into a break, so give me a call live at 888-99-CHART.
We've started the new year, and I thought it might be a good idea to let you know about a new way to make your meal preparations easier. If you are ready to get farm fresh, pre-portioned ingredients and seasonal recipes delivered right to your doorstep, HelloFresh was made for you. Now you can skip trips to the grocery store and count on HelloFresh to make home cooking easy, fun, and affordable. That's why it's America's #1 meal kit. With HelloFresh, eating well in the new year can be stress-free and delicious. With over 35 weekly recipes, they have the options you're looking for to help you achieve your goals. Choose calorie smart and carb smart recipes, or even customize select meals by swapping proteins or sides, upgrading your proteins, or adding protein to a veggie dish. When it's time for the game, you can home gate like a pro with a limited time and winning assortment of snacks, appetizers, and shareable sweets available at HelloFresh Market. Treat friends and fans to delicious barbecue baby back ribs, chocolate chip brownies, and everything in between. We all want to save money this time of year, but did you know that HelloFresh helps you save money all year round? HelloFresh is less expensive than grocery shopping and 25% cheaper than takeout. I found that it's actually a pleasure to cook with HelloFresh, and I like to collaborate with my girlfriend as we try various HelloFresh recipes. We agree that eating well is top of mind, and it's comforting to know we always get top quality ingredients with HelloFresh. HelloFresh ingredients travel from the farm to your doorstep in under 7 days. That's how you know they are fresh. So, go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus free shipping. That's right. Go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus shipping. Try it, and you'll discover why HelloFresh is America's #1 meal kit.
How many times have you had a special idea? An idea that could probably make you some serious money, if executed properly. Some people are very creative and get valuable business or marketing ideas often. But having the concept in mind and acting on it are two different things, right? I can tell you that no matter your idea or how fresh your business plan might be, you are going to need a catchy, easy to remember, and welcoming domain name to bring your idea to life in the global marketplace. This is why you should make it a point to work with GoDaddy's domain broker service. Here's what I mean. Let's say you've got the perfect domain name in mind, but you discover that it's already taken. You are going to want some expert help, and GoDaddy's domain name broker service is ready to get things rolling for you right now. The GoDaddy team of over 100 brokers works with companies worldwide to acquire domains securely and confidentially. In fact, a GoDaddy broker with expertise in your region will negotiate on your behalf to get you the lowest price while keeping your identity anonymous and ensuring that you won't overpay, and also that your plans won't be revealed early. So whether you are a Fortune 100 company or a newly funded startup, remember that GoDaddy is the leading domain broker worldwide. GoDaddy can help you get the perfect domain, even if it's not currently available. Don't let your best-in-class business idea go unrewarded. To learn more, or to see if your perfect domain name is perhaps already taken, go to GoDaddy's domain broker service at godaddy.com/DBS. That's godaddy.com/DBS. Make your dream come alive. Head over to godaddy.com/DBS. That's godaddy.com/DBS.
92% of households that start the year with Peloton are still active a year later.
92% because of a bike?
Not just bikes. We also make treadmills and rowers.
Oh, let me guess, for elite athletes only, right?
Nope. It doesn't matter if you're an avid exerciser or new to working out. Peloton can help you achieve your fitness goals. 92% stick with it. So can you. Try Peloton bikes, tread, or row risk-free with a 30-day home trial. New members only. Not available in remote locations. See additional terms at onepeloton.com/home-trial.
Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
We're going to go to Cabo San Lucas, one of my favorite places, and talk to Mac looking at Bungie.
Yes, sir. I own this stock, and I was wondering if you think it's something I should hold. It's part of a, agricultural commodity type holding.
Yeah, of course. Yeah, this is Bungie. Very large corporation, about $14 billion market cap. And it is in the agribusiness. It's the largest oilseed processing, has the largest oilseed processing capacity globally. And that's where 2/3 of its profits come from. And it also sells packaged vegetable oils and other food and ingredients products. Historically, it is a consistently profitable business, which I really like. Return on equity right now is right around 19%. Now that's probably over earning a bit. 2021, their return on equity was 44%, far in excess of what they probably should be at. But so earnings are slowing down. Last year they made almost $13 per share. This year they're supposed to make $13.86, but down 13%. Excuse me, last year $13.86. This year down 13% to $12.04. But it's a $95 stock, so even forward looking, you're getting a bit of mean reversion. I still like it. I'm fine with it. I like the commodity play and the ag business, although less kind of booming than the energy space. It's going to be more consistent, and you see that with the consistency of their business. So I see no reason to sell it. It's at a reasonable valuation, nice, solid, consistent dividend. with the ability to grow that dividend, which I like. And have they raised it recently? Yeah, they just recently raised it in early, or I guess the second quarter of last year. So I like that. I'm a fan of Bungie. I would not be selling it. Thanks for the call. Let's go to Nick in Manhattan Beach looking at CDNS, which is Cadence Design Systems.
Oh, hi, Justin. Yeah, so I've called a couple times about various semiconductor companies. Definitely interested in the space. But I realize that a lot of them are sort of like commodity-like producers, like memory of the commodity business.
Mm-hmm.
I'm looking for the stocks and the companies that have, almost monopolies in terms of
have IP.
Yeah, so I've already invested in ASML, but also I found another company, Cadence Design Systems, that is not a monopoly, but basically an oligopoly. They've got two other companies that, along with Cadence, comprise about 85% of the market share of EDA, which is electronic design automation software, which is a software that all the major semiconductor design companies need in order to create like the very complex cities that are high-end semiconductors with, I think the new Apple laptop announced recently has 67 billion transistors.
Mm-hmm.
And designing that takes the software. You can't do it without it.
Mm-hmm.
And so they've got a pretty strong value proposition. I'm wondering if, it's a little overpriced, but, that's in the eye of the beholder. But I'd like to buy it around $150 per share. I was wondering if you think that is fair for a company that has always had a pretty high PE, although that valuation has been rising over the years. Anyway, what do you think about $150 a share for Cadence?
Well, it's at 183 now. So, and 150 is definitely near the lower end of the recent range. It's been in a trading range since the end of 2020 when a lot of the growth stocks peaked. So it's certainly outperformed the growthier side of the market. So that's positive. And I like that. I like those stocks that are having that relative outperformance. Problem is that from a valuation perspective, it's come in, but not nearly enough. It's trading out at 15 times price to sales. Even at 150, you're still talking roughly 12 to 13 times, which if you look historically, buying anything north of 10 price to sales ratio is usually an iffy proposition. I like this business. They have minimum debt, actually net cash on their balance sheet. So that's not an issue. They have consistent cash flow and profitability. Let me look at the cash from operations. Yeah, that is kind of flatlined recently after years of growth. And a lot of it has to do with just simply the companies pulling back from designing as many products as they were before, slimming down SKUs and inventory, et cetera. So that's certainly hit on their business. So I like what you're looking at. This is definitely, if I'm going to invest in the semiconductor space, these are the type of names that I like. I like the way that you're thinking is there's a lot of semiconductor companies that basically produce raw commodities. Yeah, they're semiconductors, but it's the same thing from one firm to the next. Whereas I like these companies that are in the picks and shovel business, as you call it. I love those businesses. Going back to that call earlier about Volkswagen, that's what the OEM parts manufacturers, why I like those businesses better, because they're typically the picks and shovels of how to produce the end product. And those, more often than not, are much better businesses. Much, much better businesses because they're less competitive. There's usually some sort of intellectual property there that gives them that stranglehold on that consistent profitability, and they're not as subject to the whims and ups and downs of the industry. And so I like this name, and it's frankly, this is on our watch list to buy for clients. It's just too expensive. At 150, it's okay, but still it's overvalued at that level. I need this closer to 70 to 80. Right? That's a level where I start to get a little more interested. And then from a technical perspective, I think it eventually gets there. You've already seen this kind of divergence lower over the past year, and likely this is going to have a period, along with the rest of the growth side of the market, of pullback and consolidation. And so around the 75 level, that's where I would get excited about this name, but not at 120 or 150. Excuse me. All right. Let's go to Sunny in San Jose. He wants to talk about ETFs.
Yeah. Hi, Justin. Are you able to hear me?
Thanks for the call.
Yeah. Justin, are you able to hear me?
Yeah, I can hear you. What can you? What can I help you with?
Wonderful, wonderful. Thank you for giving me time to ask the question. I just came across recently with a unique kind of ETF. Mm-hmm. Usually the ETF is a basket of stocks, but this one seems to be pretty unusual, and I wasn't sure that if it is really worth taking a shot for that. Okay. This is a one-stock ETF.
Okay.
And
what
example,
ETF is this?
The symbol is TSLQ, which is a kind of inverse of Tesla.
Okay.
It is only the one-stock ETF. Okay. Similarly, I was able to find on actually Apple as well, which is they have one stock ETF, which is inverse for APP, D like a down, if you want to short Apple, APP, U like if you want to go up. So this is something pretty unique I have found. I don't know, if it is something, another rip-off kind of thing by Wall Street, or is it really a good product to be looked into, a one-stock ETF?
Well, I'm not sure why you would buy the one that goes up with the stock, but I would understand why there would be the ones that would short the individual stock, because for example, an IRA or a 401k, you cannot short stocks. So if you want to bet on the downside of Tesla, you're SOL. But if you go long a fund that is short the underlying, then you're within the guidelines, I guess. So that's what this is for. If you have a tax-deferred account like that where you want to short these, then this would be the vehicle for you. I'm not sure the mechanisms and what the costs are. It looks like the expense ratio on the Tesla one is about 1.15, so you're going to have some cost there. But that would be really the only reason to do it. Or if it was hard to borrow and you couldn't borrow it from your broker in your regular brokerage account, that might be another alternative. But those are, very special situations. Obviously, I'm not a fan of Tesla, so I think owning the one that goes shorted is probably a good idea, but it's better if you just short it yourself individually. So that's why they're here, but only to be used in those situations. Thanks for the call. Let's go to James in New York looking at Devon Energy.
Hi, how are you tonight?
You there?
Yes, hello?
Yes. Devon Energy, do you own it or looking to buy it?
I was considering buying it. I wanted to get some exposure in the space. It looks reasonably priced, but I don't know, is this possibly a value trap? I also noted a dramatic increase in dividend the last 2 years. I was just wondering about this. It wasn't quite clear to me.
Well, Devon Energy is one of the better names within the industry, that's for sure. And they've whittled down their debt to very reasonable levels, so that's a positive. They have increased their dividend, like you said, pretty dramatically to $1.55 as of September. But that has come back down here. And it looks like it's down to $1.35. So it's right-sized a bit. Sounds like they probably have a dividend policy that fluctuates with their earnings. And earnings are starting to level out and expected to actually fall 5% this year. But still, the $8.22 on a $65 stock, you're talking about roughly 8 times earnings. Pretty good. Now, so I would give this one a thumbs up. It's in the top 5 of the large E&P oil companies out there in our minds because of that low debt level, because of the quality of their assets, and the nice dividend. So if you're looking at Devon, you can do a lot worse. Let's just say that. Thanks for the call. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for their courtesy by getting to their questions quickly. Gene Coos says, OTC stock, says, can you please explain what transpires when you hold an OTC stock and they go public on a major exchange? Does the equity that you hold just roll over to the new ticker symbol? And also, if you have time, can you please give your thoughts on ticker symbol CIVI? Well, it's a good price target. Okay, so let me talk about OTC. So OTC are just over-the-counter, that's what OTC stands for, over-the-counter. Means it doesn't trade on a major exchange. Now, here's if you move from OTC to a major exchange, the NYSE, the NASDAQ, etc., your ownership stake doesn't change. That shouldn't, unless there's other things going on. But just moving to an exchange doesn't mean anything from your ownership stake. It should just roll over. Now, the good thing with that, it's always a positive because it opens itself up to more investors when you are listed on a major exchange. Because the exchanges, they have a little more oversight and they want to make sure each company that's on their exchange is of quality and is a reputable business to be invested in. And so they have requirements for being listed on their exchange because they don't want to have all these random companies and half of them frauds on their exchange. It would make them look bad. You know, they want volume, and the volume of trades, that's what they make money on. And people are only going to invest in companies for the most part that they have some trust in. So overall, it's a good thing, but the ownership stake doesn't change. Okay, so hopefully gave you the overview of the OTC versus the major exchanges. Now, CIVI is another oil and gas company, much smaller than Devon, $5.5 billion market cap. And it's called Civitas, not sure how to pronounce it. But earnings have exploded from $3 roughly in 2021 to $13.53 last year. Expected to fall down to $10.74 this year. So down 21%, but 3.1% dividend yield, which is nice. $65 stock. So Devon was trading in roughly 8 times. This is closer to 6 times forward-looking earnings. So a little bit cheaper, but smaller, less diversified. Higher risk. Let me look at their debt levels real quick, because certainly that's a big factor. Devon's debt levels are pretty minimal. Civitas has, actually no debt. So that's positive. But longer term, their profitability tends to be a little lower than Devon's and a little more volatile. So certainly higher risk, but I like it. I like the space, as you know. I like that they don't have a lot of debt. Their payout ratio is a lot lower than Devon, so more room there for that dividend to go up, which I like. So overall, value-wise, everything, Civitas would be probably a little bit better, but you're also taking more risk because it's smaller, because it doesn't have the diversity of assets that Devon has, the history of consistent profitability and consistent management execution like Devon would have. But I still like it. So it depends on your risk tolerance level. Thanks for the call. Now, we're getting a lot of live calls today, and I love it. I love your live calls. So hope to squeeze in one more talking point before we end the show. But we're going to move on to a break. So I'm ready to take your calls. You only have about 7 minutes left. So if you're going to do it, you want to do that right now. We're heading into our final break of the hour. Thank you all for tuning in. This is InvestTalk. Give me a call at 888-99-CHART.
Your objective is to work hard, plan well, and achieve financial freedom, right? You're in luck, because Justin Klein is here now, ready to take your finance and investment questions. Call 888-99-CHART.
Hey, Stephen, Justin, this is Chris calling from San Diego. Actually, I had 2 questions. First, real quick, Barrett Business Services, ticker symbol BBSI. Just wondering what you guys think of this company. And my second question is there like a rule of thumb, or what do you recommend to have as an allocation for options trading? So 1% of your portfolio, 2% of your portfolio, just to have particularly for options trading or to do some shorts to help hedge against some downside in your broader portfolio movement. Thank you guys so much. Love the show. Bye.
All right. BBSI is Barrett Business Services. It provides payroll administration services, and it's a staffing agency as well. So in a tight labor market, they tend to do well. When the labor market weakens, not so much, right? So most companies, when they're on the path to hire and they're waiting to find the right candidate, they often hire some temps, maybe some temps to hire. And they use a company like Barrett Business Services. So in a tight labor market, they do well. We're entering a less tight labor market, let's just say that. So I think they're over-earning right now. Probably not a name I'd buy in the near term. Now, longer term, if we have our workforce is roughly 3 million less than it was pre-pandemic because a lot of the boomers retired, that is generally a positive for a company like Barrett Business Services. And I like their longer term consistency. So I would say it's a good name to have in your watch list. I just wouldn't buy it right now because we're kind of in the end of the tight labor market cycle. And with all the layoffs in the tech industry, I think they're going to start to see a pretty loose market. Now, when it comes to option trading, it depends on what you're executing. Are you doing iron butterflies? Are you doing cover calls? Are you just straight outright buying naked options? What are you doing? So it's hard for me to say. And what's your risk tolerance level? It's hard for me to say, I should slice off this little part of your portfolio to do option trading. For the most part, I would say none. Most people do terrible with options. Most people buy options, they lose money. They're betting big. Yeah, there's some big payoffs, but most of them they're losing money on. So unless you're very sophisticated, you really know what you're doing, I probably wouldn't be dabbling there. So if you're going to, make a very small percentage. Thanks for the call. Now let's touch on the remodel market. And there's a key measure of remodel activity, which predicts that American homeowners will spend a record $485 billion this year on renovations and repairs. Now, this is a sharp deceleration of growth from the pandemic. So in 2020, year-over-year spending rose 16%, and it was up 12% in 2021, and 10.6% in 2020. This year, the growth is only supposed to be 2.6%, so a sharp deceleration. And this doesn't include house flippers and landlords. So if you think about it, home flipping is going to be a terrible business. They're pulling back dramatically because a lot of what home building profits come from, and I know some home flippers, it's just price appreciation as they're going through the remodel. So when you're entering a market that is now falling, you're dealing with massive headwinds versus in a positive market, you're dealing with nice tailwinds that, you're adding some value with your renovations, but a lot of the gain is just simply holding that property for that 6, 9, 12 months before you actually sell it again. And now it's the opposite. And so they're going to stop spending. So that means less trips to Home Depot and Lowe's. And then also, and this is a projection. I actually expect it to shrink this year. Okay. So the projection is 2.6%. I actually think it's gonna surprise the downside. Why? Because higher borrowing costs. It's more expensive to tap your home equity to pay for these major repairs and renovations. So just be aware of that sharp deceleration. And this is coming from, who's the prediction? This is from Harvard University's Joint Center for Housing Studies. So good thing they're not conflicted. If this is like, if the National Association of Home Builders, Realtors, they're always way more bullish on the housing market than they should be. Luckily, this is coming from a more balanced source, but still, I think they're going to miss the mark to the downside. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley, and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And we just crossed over the 49 million download mark thanks to you. And be sure to rate and review on iTunes. Helps raise our profile and helps spread the word. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461.